Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. So right now, click subscribe, hit the bell, and a great video is coming your way right now. Hey everyone, I'm Roger Herring, and I am the Investor's Accountant, just like the sign says. Welcome to another edition of Ask Roger. Now, today's question is one that I get all the time, but I've never spoken about it on camera. And I think it's probably time that I need to do this because I keep getting asked over and over. There's actually two questions. First question, Roger, if I lend money to my company, do I have to charge interest? And second question, Roger, if I lend money to my company, do I have to have a note payable, note receivable between me and the company? Well, here you go, guys. If the loan is less than $10,000, then no, you do not have to charge interest. But if it's $10,000 or more, then yes, the law requires that you charge interest. Code section 7872 says any loan greater than $10,000 must have interest at least the applicable federal rate. Now, what the heck is that? AFR rates are published every single month by the IRS, and that is the amount of interest that is the minimum that you can charge on a loan of $10,000 or greater. Now, it's not very much. In fact, it's less than 1% right now. You may say, well, that's a bunch of much ado about nothing, Roger. What does it matter? You don't want to get in trouble with the IRS. So if the loan is more than $10,000, go look up the federal AFR rate, charge that as the interest, and actually pay the interest at the end of the year. Otherwise, it can cause some balance issues and all that. That's a whole other story, though. Okay, second question. Raj, do we need a note payable? The law doesn't say that you have to have one. But best practice, and it's better for you, if you do indeed have a note payable, whether it's $1,000, $10,000, or $100,000. Well, why? Number one, it proves that you were loaning money to the company. You see, in the absence of a loan, the IRS has the ability to come in and say, oh, you meant dividend. No, that's a loan. Here's where I put the money in. Oh, you meant dividend. Too bad for you. Okay, the answer is have the note. That's reason one. What's reason two? Reason two is if you pay that note back. Here you go, guys. Remember when we've talked the past couple of times about this thing called basis? Here's where basis really comes in. Okay, so here's the thing. Let's say that you put in $100,000 into your company. That's what you got it started with. And over the next 3 years, you lost $100,000. In order to write it off, you have to personally fund the loss. So we can use our loan basis, which now goes to zero, and we get to write off $100,000 against our other income over on our 1040. Now, let's say that next year, though, things start turning around. And all of a sudden, I made $50,000. That's pretty good. But now I want to pay back some of this 100K. Do I have a basis here? No, I don't. So I pay back $50,000. I have no basis. What I have is a taxable income. But how it is taxed is determined by whether or not you have a note. If you have that note payable and it's on file, guess what? This 50 grand will be taxed as a capital gain. But if there is no note payable when you pay back that $50,000, guess what? That's right, it's ordinary income. Ouch. And guys, this is not the income the company made. This is on whatever you paid back on the loan. So if your company made $50,000 in income, you've already got that. But now guess what? You've got an additional amount over here. Is it capital or is it ordinary? Whether or not you have a note is the determining factor. Guys, I know this seems a little bit confusing. What we're going to do is the next time we do a podcast, we're going to talk about this in detail. Until the next time, Roger out.